All right, if you've been keeping an eye on the markets, I'm willing to bet you've felt a little bit of anxiety around your software stocks. As your advisor, I want to help you cut through all of that noise. Today, we're going to build a calm, rational framework to really look at these companies, especially for those of us who are focused on the long term.
You might have even heard this term being thrown around in the financial media, the SaaSpocalypse. It's a dramatic name, for sure, but it points to a very real and pretty significant downturn in software-as-a-service stocks. SaaS companies.
And when you look at the numbers, they're alarming. We're not talking about small, speculative startups here. These are established industry leaders. Salesforce has been cut in half. Adobe is down 60%, and Atlassian has seen a staggering 85% fall from its peak. It's enough to make even the most seasoned investor feel nervous.
So here's our plan to navigate this. First, we'll get a handle on the sell-off itself. Then we'll compare the market panic to what's actually happening in the businesses. We'll build an investor's toolkit and then put it to work with a case study. We'll also tackle that big AI threat, and we'll wrap up with a checklist you can use to spot potential opportunities.
Okay, so let's just dive right in. What is really at the core of all this nervousness in the market? Why now?
Well, it really just boils down to one thing: uncertainty. The main fear that's driving this huge sell-off is the rise of artificial intelligence and its potential to just completely upend the software business models we've known for years. The big worry is that AI could make the software we use today way less necessary, or, maybe even obsolete.
And that brings us to what I think is the most important distinction for any long-term investor: separating the emotional market noise from the actual fundamental health of a company.
Now, this is what's so fascinating. There's this incredible disconnect. On one hand, you've got stock prices just collapsing, down 50, even 80%. But on the other hand, for so many of these companies, the actual businesses themselves haven't collapsed at all. In fact, their revenues are still growing, and a lot of them are still very profitable.
So this leads us to the million-dollar question, doesn't it? For us, the patient investors, are we looking at a falling knife here, something that's just going to keep dropping? Or is all this market panic actually creating a genuine bargain for those of us with a long-term view?
To answer that question without getting swept up in the emotion, we need a disciplined framework. A repeatable process that helps us stick to the facts, not the fear.
Our valuation really rests on three key pillars. First, we have to audit the financial health to make sure the company is stable. Second, we need to verify its competitive moat. Does it have a real durable advantage that protects it? And third, we have to assess the valuation. Is the current price a fair deal, or has the market oversold it?
Okay, let's get practical. Let's take our new toolkit and apply it to Salesforce, one of the biggest names caught right in the middle of this whole thing.
So a quick look reveals a really strong business. It's the market leader by a lot. Its software is so deeply woven into how its customers operate that it's incredibly difficult for them to leave. That's a classic, powerful moat. And financially, it's really healthy with a low debt-to-equity ratio. Plus, it has enough cash sitting there to pay off about 2/3 of its debt tomorrow if it wanted to. This is a fundamentally solid company.
So here's the crucial point. Even though the business fundamentals are strong, revenue's up, cash flow is up, the stock price has been cut in half. And if the business is this solid, you have to ask yourself, what is the market so afraid of? Well, it all comes back to AI. Let's tackle that elephant in the room head on. Is AI this massive existential threat that's going to make companies like Salesforce obsolete? Or is it something more manageable, like a pricing challenge? The fear really comes down to two scenarios. The absolute worst case is that new AI agents just swoop in and completely replace the software we use now. The other, and maybe more likely scenario, is that AI makes teams more efficient, so companies need fewer employees, which shrinks that traditional per-seat pricing model that so many software companies rely on. Let me give you an analogy. Think about your office electricity bill. Maybe you have fewer employees now, but if each one of them is using powerful AI tools that need a lot of computing power, your overall need for that electricity might not go down at all. The way the bill gets calculated might have to change, but the fundamental need for the service is still there.
Okay, so let's put this all together into a checklist, something actionable that you can use to find quality companies in the middle of all this panic.
Here are 5 key questions to ask. 1. Does it have that sustainable moat? 2. Is the balance sheet strong with low debt? That's our stabilities check. 3. Does it have a long cash runway, enough cash to operate for several years without needing to borrow? 4. Is its price-to-sales ratio low compared to where it's been historically? That can help us spot a bargain. And 5, is it generating positive and ideally growing free cash flow? A yes to these questions is a great sign.
And what's great is that this framework applies across all different kinds of software companies. Whether it's customer management like Salesforce, creative tools like Adobe, internal workflows with Atlassian, or data infrastructure like Snowflake, each of these has its own unique, deeply embedded role in the economy, which gives it a certain level of durability.
And really, this is the key takeaway for all of us. For a disciplined, long-term investor, this kind of volatility isn't something to be afraid of. In fact, these knee-jerk reactions from the market are exactly what create the potential mispricings and opportunities we're looking for.
So at the end of the day, it all comes down to this: maintaining your emotional discipline and focusing on the true underlying health of a business. That is the key to navigating and maybe even profiting from these periods of market overreaction. The question you have to ask yourself is, which signal are you going to tune into? The panic or the fundamentals?